base with Saurabh Mukherjea to get in a better perspective on how he's viewing the impact of elections on the markets and also the macros, so to speak. Saurabh, it's great to have you in the show. Thanks very much for taking out the time. Let's take it from the top. First trigger for the markets is really what comes out in the Karnataka elections. It's still, 11th or 59th minute scramble to figure out who should form the government, with whom that is. How do you see this election influencing the course of the markets over the course of the next 12 months? Because post Karnataka, the focus would largely be on Chhattisgarh, Madhya Pradesh and Rajasthan.
Look, whilst I'm sure the horse trading that's taking place in Karnataka is very interesting for all of us, it's sort of fascinating to watch politicians sort of trying to grab power. I'm not so sure a long-term investor really will pay too much attention to it. Most of the sort of meat of the election we got yesterday, which is that the BJP did better. The BJP did better in the election than was expected. I'm not so sure there's that much for the market to now discern this point in. What I think that the market will now focus on over the next 12 months is how many more such elections will we have where the power picture gets convoluted. Will Rajasthan, will MP, will Chhattisgarh, will they also be similar elections with convoluted outcomes, or are we heading for clearer political climes? And that apart, the other tussle that investors are playing out is higher GDP growth on the one hand, with higher inflation and higher cost of capital on the other. I think that's the crux of the situation. I'm not so sure the identity of the government forming, which party forms a government in Karnataka, really will have that much of a bearing on the stock market.
But sort of with the yesterday's volatility and about 1.5% this way and that on the index, and even a bigger swing when it came to the broader markets, is the market already pricing in whatever the outcome may be this way or that, or do you sense once the gray zone becomes a little clearer, who's going to be forming the government in Karnataka, the market will have another bout of reaction?
I really don't think the market's going to care too much either one way or the other. As I said, for those in the stock market who are worried about policy continuity and the NDA, having a good show in the general elections next year, they got what they needed yesterday. They realized that the BJP continues to be a very popular party. The BJP did better than the pollsters had predicted. Beyond that, I don't think there's that much great sort of symbolism in who sits in the Vidhan Sabha in Bangalore from a stock market perspective. I think the rest of the market will now focus on the sort of the day-to-day grind of where are we on inflation, where are we on the 10-year bond yield, on the currency front, and on, most importantly, on corporate earnings. So there is clearly a revival in corporate earnings, but there's concerns elsewhere. And I think that seesaw is what will play out in the market over the next 6-7 months. I don't think the market's going to lose too much sleep about which party comes to power in Bangalore.
Since you mentioned Saurabh, seesaw, that brings me to the divergence that we are seeing within large caps and mid caps. At a time when the Nifty has recovered 7% from its previous 2 months' lows, the mid caps are really seeing a bloodbath of sorts. So you can't really draw a correlation. You can't really say, just looking at the Nifty, what's happening with the market, because looking at the broader markets, it's a completely different picture. What explains this divergence?
I think I've been saying this for the last 4 or 5 months, that once you have rising input cost pressure, commodity prices are rising, cost of capital is rising, smaller companies obviously struggle in such a climate. They don't have the pricing power to deal with higher cost of capital, higher cost of raw materials. And you can see that. You can see operating margin pressure clearly building up in this set of results in both Q3 and Q4 results for small and mid caps. So I think there's a natural rotation that will take place this year in the current fiscal, away from small and mid caps towards large caps, especially towards large caps which are plays on an economic recovery, such as metals and mining companies, industrial companies, CASA funded lenders. So there's a long overdue rebalance, I think, necessary. I think we'll see that next year, away from small and mid caps into large caps. I think the SEBI rule change on large cap funds not being allowed to put too much money in small and mid caps also is hurting small and mid caps. Clearly, large prominent large cap funds are rotating away whatever little exposure they had to small and mid caps. So there's a technical factor as well to contend with. But I think through this year we will see a sustained operating margin pressure on small and mid caps alongside what is clearly a pronounced economic recovery in India.
I can argue back and say that look, mid caps have corrected, and selectively maybe you will find better value in mid cap versus large cap, because this is not Jan 2018 where there was definitely a price froth.
Sure.
Now a reasonable amount of cleansing has happened, so to speak.
So obviously, Nikunj, I mean, in a 200, 300 small and mid cap world, there will be outstanding companies who, in spite of being deemed to be small and mid caps, they are sector leaders, they have pricing power. So if a company has pricing power, regardless of whether it's large, small or mid cap, they'll be all right. But with a lot of smaller companies, they don't have the pricing power. And if you don't have pricing power in a year like this, where commodity prices are rising, where cost of capital is rising, if you don't have pricing power, you're going to see operating margin compression. It's visible in the Q3, Q4 results. I think it'll become more pronounced as the year carries on. So I agree with you. It's not just a question of being small and mid cap and therefore suffering. It's a question of, are you a market leader? Do you have the ability to turn around to your customer and say, no, my operating margins are going to stay fixed. I'm not going to sacrifice operating margins. Or are you a company who says, well, I want to keep my top line growth going, so I'll take an operating margin sacrifice. My hunch is most of our small and mid caps are in the latter category.
Saurabh, you know what I have always in a sense appreciated about the fact that you are the first, you are really ahead of the curve in identifying some mega trends, whether it was, you know, the whole crackdown on black money, financial inclusion. We were talking about it in 2015-16, nobody had a whiff of it, and now things have transpired in the right direction. Organized versus organized sector. Some of these themes have played out. But let's say if you have to talk about one or two new mega trends, which do you think will play out in next 2 or 3 years, and there is opportunity to be, there's money to be made, whether it's a P expansion or whether there's earning expansion. Which are the new mega trends you would like to bet on?
I think there's this one in the financial sector that one can clearly see, and there's one in, I think, in the broader economy. I think in the financial sector, it's reasonably clear that we are head for a, I would say, decade-long boom in financial savings. I think we had the 2003 to 13 period where we pumped away insane amounts of money into residential real estate. It's quite unbelievable as to how much money we put into residential real estate in that 10-year period. Last 3 or 4 years, the tide has changed, and my reckoning is that 10 years hence, we'll be doing something in the vicinity of $1 trillion a year in household savings. We're doing around $250 billion a year in household financial savings. I think 10 years hence will be in the vicinity of $1 trillion a year. Therefore, the whole financial savings piece, life insurance, asset management, wealth management, brokerage, I think that will enjoy the sort of boom in the next 10 years that lenders have seen in the last 20 years. So I think that's a big theme coming up, and structurally that's great news for the country. It'll drive our cost of capital lower and create a more efficient economy. And the second trend, I think, will be in large caps. I think there's just too much focus on financials, in the sense that lenders and especially non-bank lenders seem to me to be too heavy in our stock market. They have around 40% of the weight of the Nifty. I think lenders, will take a back seat, as savings-driven institutions in financial services come to the fore. But also I think industrials, manufacturing will become a larger part of the stock market. As the country becomes more efficient, as land prices drop, cost of capital drops, I think the stock market will broaden out beyond just being 40% in BFSI, and then another 10-20% in IT, FMCG, pharma. So it will become a broader stock market. I think manufacturing, industrials, metals and mining will be sectors which I think will do better in the next 2 to 3 years than they have done in the last 3, 4, 5 years.
What do you do with spaces which have had a great time in the last 1 year though, Saurabh? I mean, there are earnings backing some of the FMCG and consumption companies,
Right.
but there are valuations as well which are riding high. So you're almost reaching at that last point where you take a call whether you stick by with the stock, do you sell out of that, deploy that money elsewhere, or do you continue to ride the wave?
I've never been that focused on saying, it's expensive and therefore we should sell it. My view is if a company is able to generate plenty of free cash flow, i.e. return on invested capital is substantially above cost of capital, then even if the company is expensive, it could turn out to be a long-term champion. But I think one area where I keep sort of reiterating my concerns is our NBFC construct, and in both I'm using NBFC in the widest sense of the word to include housing finance companies. These guys are borrowing short-term money, 3-month, 12-month money, and they're giving 20-year home loans. It's not clear to me how good the asset quality is. In fact, I think the last 3-4 quarters, it's pretty clear that even in some of the more steadier housing finance companies, you can clearly see asset quality deterioration. And now that the cost of funding in the wholesale markets has started to rise, I think we're long overdue a rebalance away from obsessing about NBFCs towards CASA funded lenders, i.e. lenders, especially private sector lenders who have a track record of choosing assets selectively and having super CASA franchises. I think there's a rebalance there, and I think this obsession with NBFCs and HFCs, I think, has turned out to have created a bubble in that space. Beyond that, I'm not so sure FMCG is that much of a bubble. I know they're expensive, but given the sort of volume growth we are seeing from the FMCG firms, given their return on capital employed, I don't think there's a great case for saying that rotate away from FMCG. I think IT and pharma, IT's already had a recovery run in the last 6 months. I think it continues on the back of the weak currency. I think pharma seems to me to be overdue a recovery. I know the FDA issues are tricky, the FDA issues are big, but I think pharma stocks seem to have been beaten down overly given the underlying strength of those franchises.
Saurabh, I keep asking our market guests this time and time again, at a market level like this, where valuations are seeming a bit stretched, does it help to be contrarian, and if so, where?
So I wouldn't say that just because the market's expensive, you sort of sell and run away. The Indian market I've never felt as particularly amenable to sort of short-term entries and exits. But yes, if you own companies where the PE multiples are elevated, the valuation multiples are elevated, and the earnings growth is nowhere there to justify that sort of valuation multiple, the return on capital employed isn't particularly good, then I would be careful. If you want to make money in the Indian stock market, I think the mantra that usually has worked for me over the last 10 years is buy great companies, super cash flows, strong management teams, buy them, sit tight for 3, 4, 5 years, you make money. Timing the market and trying to say it's expensive today, which it is. I mean, I'm not denying that the Indian market is expensive today. I think it's 10 to 15% overvalued. But trying to time it by saying I'll sell today and buy 6 months from now when it's cheaper, that's never been a particularly sort of clever way of making money in the Indian stock market. At least for me, it hasn't worked.
Well, that's the biggest truism, isn't it? That ultimately when you're buying a business or buying a company, you're focusing on future cash flows, and that's how you value assets. Okay, Saurabh, good luck and thank you for joining us, and enjoy your stay in Delhi.